Welcome to CoreLogic's Housing Market Update for August 2021, brought to you on behalf of Credit Union SA. Australian housing values increased a further 1.6% last month, taking home prices 14.1% higher over the first 7 months of the year and 16.1% higher over the past 12 months. The annual change in national housing values is now the fastest we've seen since February 2004. However, in a sign the housing market's losing some steam, the monthly growth rate has been trending lower since March earlier this year, when the national index rose by 2.8%. The gradual easing in the rate of housing value growth can probably be attributed to a combination of affordability factors and less stimulus. With dwelling values rising more in a month than incomes are rising in a year, housing is moving out of reach for many members of the community. Along with declining home affordability, much of the earlier COVID-related fiscal support, particularly fiscal support related to housing, has expired. On the flip side, demand is being stoked by record low mortgage rates and the prospect that interest rates will remain low for an extended period of time. The number of home sales is tracking approximately 40% above the 5-year average, while active listings remain about 26% below the 5-year average. This mismatch between demand and advertised supply remains a key factor placing upwards pressure on housing prices. Although the pace of growth has slowed, housing values continue to rise at a rate that's well above average across most areas of the country. The previously stronger performance across regional markets relative to the capital cities has normalised through 2021. After the combined regional areas of Australia recorded stronger housing market conditions through the second half of 2020, the first 7 months of 2021 shows an almost equal rate of growth, with values up 14.5% across the regions and 14% across the capitals. In another broad trend, houses continue to record much stronger growth in values relative to units. At the macro level, national house values are up 18.4% over the 12 months ending July, while unit values have risen by less than half that amount, up 8.7%. Clearly, there's been a shift in preferences away from higher densities. However, with affordability pressures mounting across the detached housing sector, we could see more demand gradually deflected back towards higher density housing options. Advertised listing numbers remain well below average across most parts of the country, despite the number of new listings added to the market trending higher than average. Recently, there's been some volatility in new inventory levels, with the number of newly advertised properties falling sharply across Sydney and Melbourne amidst the lockdowns. We've seen the same trend through earlier lockdowns, where both buyer activity and vendor activity reduced before recovering back to pre-lockdown levels once the restrictions are eased or lifted. On the demand side, the number of home sales has held well above average over the year, with CoreLogic estimating a 42% year-on-year lift in the number of sales. The annual number of home sales hasn't been this high since the year ending January 2004, with the past 12 months recording nearly 600,000 dwellings sold across the country. That's approximately 140,500 more sales than the decade average. With stock levels remaining tight and demand so high, selling conditions have been skewed towards vendors. The combined capital cities auction clearance rate averaged 73% through July, and private treaty sales continue to record rapid selling times and low discounting rates. Considering the tight advertised supply levels and high demand, prospective buyers are likely to be feeling a sense of urgency due to the level of competition in the market. However, with affordability constraints starting to impact purchasing capacity, it's possible market activity could reduce through the second half of the year, helping to rebalance the market and take some further heat out of the rate of house price growth. Adelaide housing values are up 1.7% in July, taking the annual growth rate to 15.7%, the highest level since the global financial crisis. Housing demand has surged across Adelaide, with the number of home sales over the past year the highest since 2002. With demand at the highest level in almost 2 decades, advertised supply levels are around record lows. Active listing numbers were around 34% below the 5-year average at the end of July, demonstrating a severe shortage of available supply that's keeping upwards pressure on housing prices. Across the sub-regions of Adelaide, the pace of annual capital gains ranges from a 26.8% lift in values across Burnside through to a 3.4% rise across the inner city precinct. Overall, Australia's housing market remains in a strong position. However, signs of slowing rates of appreciation have become more evident. The pace of capital gains has been tapering since April this year, which can be attributed to growing housing affordability challenges along with less fiscal support. It is likely that recent COVID outbreaks and associated lockdowns have contributed to some of the loss of momentum as well, particularly from a transactional perspective in Sydney, which is enduring an extended period of restrictions. Previous circuit breaker lockdowns have generally seen housing values remain resilient to falls, but the number of home sales and listings activity has been more substantially disrupted in the most recent lockdowns. Once restrictions are lifted, it's likely pent-up demand will flow through to an increase in activity. However, it's reasonable to assume the uncertainty associated with the duration and severity of Sydney's lockdown could see a greater level of disruption relative to previous, shorter periods of restrictions. Although the rate of growth has eased, housing values are continuing to rise substantially faster than average. Over the past 10 years, the average pace of monthly dwelling value appreciation has been recorded at just 0.4%, compared with last year where the monthly growth rate has averaged 1.3%. It's likely the rate of growth will continue to taper through the second half of 2021 as affordability constraints become more pressing and housing supply gradually lifts. Other potential headwinds are apparent, including the possibility of tighter credit policies and an earlier than expected lift in interest rates. Tighter credit policies, should they be introduced, would likely have an immediate dampening effect on housing markets. However, the trigger for another round of macroprudential intervention isn't yet apparent. APRA and the RBA and the broader Council of Financial Regulators are watchful for any signs of a material slip in lending standards, as well as a more substantial lift in household debt or speculative activity. While each of these metrics is on the rise, the level is likely to be insufficient to trigger a response from APRA. Similarly, a lift in the cash rate is likely to be some time away, but depending on the trend in labour markets and inflation, we could see rates potentially rise earlier than the RBA's 2024 forecast. The recent spate of lockdowns is likely to see Australia's economy once again contract through the September quarter, a factor that could keep rates on hold for a while longer, providing ongoing support for housing demand. Over the short term, let's hope the recent COVID outbreaks are contained so restrictions can be lifted. Chances are we could be in for an active spring season as pent-up demand is unlocked, but that really depends on whether restrictions are lifted. In the meantime, you can keep up to date with all things housing at CoreLogic.com.au.